Have you noticed something strange happening in the global financial system? The US dollar is still the strongest and most used currency in the world, but quietly, slowly, and steadily, its power is beginning to weaken. Most people do not see it yet because these changes do not happen in one night. They happen over years, sometimes decades. But when the shift becomes obvious, it is usually too late to prepare. Today, we are going to break down one of the biggest long-term stories in the financial world, and how it could impact gold, silver, inflation, and your future wealth. Welcome to Gold Silver Scope. A major global economist recently made a bold statement. He believes that within the next 5 years, China's currency, the yuan, will become a global reserve currency. Now, many people hear that and think it means the dollar will collapse tomorrow. That is not what it means at all. It does not mean the dollar suddenly disappears. It does not mean America loses all financial power overnight. What it really means is something much bigger and more important. It means the world may be moving away from relying on only one currency and toward using multiple powerful currencies. To understand why this matters, first we need to understand what a reserve currency is. A reserve currency is a currency that central banks, governments, and institutions hold in large amounts for trade, savings, debt payments, and international transactions. For decades, the US dollar has been the king of this system. Oil has been priced in dollars. Trade deals have been settled in dollars. Nations have stored dollars as protection. This gave the United States enormous advantages. When the world wants your currency, you gain power. You can borrow cheaply. You can print money with less pain than others. You can buy goods from around the world using paper or digital money everyone accepts. This helped create higher living standards and stronger financial influence for many years. But history shows no currency stays on top forever. In earlier centuries, Portugal had influence. Spain had influence. The Dutch rose. France rose. Britain dominated for a long period. Then the US dollar took the throne after World War II. Every empire looks permanent while it is strong. Every reserve currency looks unbeatable until change begins quietly underneath it. Now here is where many people misunderstand the situation. Reserve currencies do not switch like turning off one light and turning on another. The dollar does not suddenly die, and the yuan suddenly replaces it in 1 week. Global systems move slowly because the financial world is built on contracts, trust, habit, infrastructure, and convenience. Think about how difficult it would be for the world to switch currencies overnight. Trade contracts would need rewriting. Payment systems would need rebuilding. Banks would need new settlement systems. Debt markets would need adjustment. Software systems would need replacement. That takes years and costs huge amounts of money. This is why the dollar remains dominant even when cracks begin to appear. There is another powerful reason. Networks create strength. If almost everyone already uses dollars, then using dollars remains easier for everyone else. Businesses prefer what customers use. Governments prefer what markets trust. Investors prefer what has deep liquidity. This creates a cycle where the dollar remains strong because it is already widely used. But something important has started to change. Countries are slowly looking for alternatives, not because the dollar is useless, but because dependence on one currency creates risk. If one nation controls the main payment system, sanctions, trade pressure, and political decisions become global tools. Many countries now want more options. That is where China enters the picture. China is one of the world's largest economies, one of the biggest trading nations, and a growing financial force. It wants its currency to play a larger global role. This is not random. This is strategy. China understands that currency power brings economic influence. So when experts say the yuan may become a reserve currency, they do not mean it replaces the dollar tomorrow. They mean central banks may begin holding more yuan. Trade deals may increasingly use yuan. Commodity purchases may slowly involve yuan. Regional financial systems may expand around yuan usage. Step by step, the currency gains importance. Imagine the dollar today as a king sitting on a very high mountain. It may remain king for years, but if the mountain becomes smaller while another mountain rises, power starts to rebalance. The dollar may stay number one, but by a smaller margin. That shift alone matters. Why? Because even small declines in reserve demand can create major long-term effects. If fewer countries need as many dollars, demand softens. If global reserves diversify, selling pressure rises slowly. If confidence declines, America may lose some of the unique benefits it enjoyed for decades. This can eventually show up in everyday life through inflation. A weaker currency means imports cost more, energy can cost more, manufactured goods can cost more, living expenses rise, savings lose purchasing power, workers need more income just to stand still. Now ask yourself this question. If currencies are competing and trust is slowly shifting, what assets historically protect wealth during currency transitions? The answer often includes real assets. Gold has thousands of years of monetary history. Silver has both monetary and industrial demand. These metals do not depend on central bank promises in the same way paper currencies do. That is why serious investors watch reserve currency trends closely. They understand this is not just about America versus China. It is about purchasing power, debt systems, inflation risk, and where capital may flow over the next decade. And here is something many people miss. This trend did not begin yesterday. It has been building for years. The share of global reserves held in dollars has slowly declined over time. The euro gained some share, but has not fully replaced anything. Meanwhile, the yuan, once almost irrelevant in reserve discussions, has gradually entered the conversation. That may sound small, but small beginnings often lead to major endings. Many of the biggest financial shifts start quietly, while most people are distracted by short-term headlines. So, what should smart viewers focus on now? Not panic, not fear, not dramatic collapse stories. Focus on direction. Is the dollar gaining dominance or slowly losing share? Is China pushing global yuan adoption? Are nations buying more gold? Are central banks diversifying reserves? Those questions matter far more than daily market noise, because fortunes are not usually made by reacting late. They are made by seeing slow trends early. And in the next part, we are going deeper into why China is aggressively building long-term currency power, why gold may be at the center of that strategy, and why silver could become one of the biggest surprise winners if this trend accelerates. What China is doing right now is not accidental, and it is not short-term. It is part of a long-range strategy that many investors still underestimate. While most people focus on daily stock market moves, crypto headlines, or central bank speeches, another game is being played in the background. It is the game of monetary influence, trade power, and reserve currency status. And in that game, China has been preparing for years. To understand this clearly, ask yourself one simple question. If a nation wants its currency to become more trusted globally, what must it do? It must become too important to ignore. It must dominate trade routes, manufacturing, exports, infrastructure, finance, and confidence. China has been working on nearly all of these areas step by step. China became the factory of the world. It built supply chains that reach almost every continent. It expanded trade relationships across Asia, Africa, the Middle East, and Latin America. It invested in ports, roads, railways, and energy projects. These moves are not only economic, they also create future demand for Chinese influence and potentially Chinese currency. When two countries trade heavily with China, they naturally ask an important question. Why settle every transaction in US dollars if we can settle some deals directly in yuan? That is how currency adoption grows. It does not start with everyone switching at once. It starts with bilateral trade agreements, regional deals, and selective use cases. Then it expands. This is why many analysts say the future may be a multipolar currency system. That means not one king currency controlling everything, but several important currencies sharing power. The dollar may still lead, but the yuan may become much stronger than it is today. The euro may remain relevant. Other regional currencies may grow in importance as well. Now let us connect this directly to gold, because this is where the story becomes even more interesting. China has been one of the largest gold producers in the world. It has also been one of the largest gold importers. That is not a coincidence. Nations understand something private investors often forget. Gold carries trust when paper systems face doubt. Gold does not need permission. Gold does not rely on another country's promise to pay. Gold has no counterparty risk in the traditional sense. If a nation wants to strengthen confidence in its financial system, holding gold sends a signal. It tells the world that behind the currency stands a hard asset with centuries of monetary respect. Even if a currency is not officially backed by gold, large gold reserves can still improve confidence. This matters because trust is everything in money. A paper note has value because people believe in it. A digital balance has value because people trust the system behind it. If trust weakens, currencies weaken. If trust rises, currencies strengthen. China appears to understand this deeply. While many Western economies expanded debt rapidly, China has been quietly increasing gold influence. This does not guarantee victory, but it shows serious preparation. Now think about the U.S. side of the equation. America still has enormous strengths. It has deep capital markets, military influence, legal systems, innovation, and the largest reserve currency network in the world. Those advantages are real. But America also faces rising debt, repeated money creation cycles, political division, and inflation concerns. When debt becomes too large, governments often choose one of three painful roads: higher taxes, spending cuts, or currency debasement through inflation. Historically, inflation becomes the easiest political option because it is less direct and less obvious to the average person at first. That is why many analysts expect the purchasing power of the dollar to continue declining over time. Maybe not in a dramatic crash, but through a slow erosion. Prices rise, savings buy less, wages struggle to keep pace, daily life becomes more expensive. Now, where does silver fit into all this? Silver is unique because it is both a precious metal and an industrial metal. Gold is primarily monetary and defensive. Silver can benefit from monetary fear and industrial demand at the same time. It is used in electronics, solar panels, medical applications, batteries, and modern technologies. So, if the world enters a period of currency uncertainty, silver may benefit as a store of value. If industrial expansion continues, silver may benefit from demand growth. This dual role is why many investors believe silver can outperform in certain macro cycles. And remember, silver is a much smaller market than gold. Smaller markets can move faster when capital flows increase. If even a modest amount of investment money rotates into silver, price moves can become powerful. Now let us talk about central banks. Around the world, many central banks have increased gold purchases in recent years. Why would institutions with access to economists, models, and policy tools buy gold heavily? Because they understand risk management. They know fiat systems are strong until confidence weakens. Gold is insurance against policy mistakes, debt stress, sanctions risk, and inflation. That should tell everyday investors something important. If central banks are diversifying, perhaps individuals should at least study diversification too. The biggest mistake people make during long-term shifts is waiting for headlines to confirm everything. By the time mainstream media says a major monetary transition is obvious, many asset prices may already have moved significantly. Smart investors watch footprints before the crowd sees the parade. rising gold demand, expanding UN trade settlements, declining dollar reserve share, structural inflation, commodity repricing. These are footprints. Does this mean sell everything and panic? No. Extreme reactions are rarely wise. It means understand the cycle. Understand that paper assets, cash savings, and purchasing power face different risks than they did 20 years ago. The world may be entering a decade where real assets matter more, debt matters more, inflation matters more, and currency competition matters more. Gold protects against loss of trust. Silver offers monetary protection with growth potential. Productive assets can also matter. The key is awareness. Now let us bring this story back to everyday life, because global reserve currency changes may sound distant, but the effects can become very personal. You may never trade currencies, never buy bonds, and never speak to a central banker, yet these shifts can still affect your food bill, your rent, your savings, and your future standard of living. For many decades, the United States benefited from having the world's dominant currency. Other countries needed dollars for trade, energy, debt payments, and reserves. That created constant demand for dollars around the world. As long as the world wanted more dollars, America could run larger deficits, borrow heavily, and import goods with fewer immediate consequences than most nations would face. But what happens if the world slowly needs fewer dollars? This is where the long-term pressure begins. If central banks diversify reserves, if trade deals move partly into other currencies, and if alternative systems grow stronger, then some of the artificial demand for dollars starts to weaken. Not overnight, but gradually. When demand softens while supply remains large, value can decline. And when currency value declines, purchasing power falls. That means more money is needed to buy the same goods and services. This is why inflation can remain a major issue even if governments claim they are becoming more disciplined. Many dollars already exist in the global system. Some are held abroad. Some are used in trade. Some sit in reserves. If confidence changes and those dollars circulate differently or flow back toward domestic markets, price pressure can rise. Think of it like water behind a dam. Even if you stop adding more water today, the water already stored still matters. If the gates open, pressure moves fast. In the same way, previously created money can still create future inflation effects. That is why many analysts believe inflation may come from two directions. First, domestic policy such as spending, deficits, and money creation. Second, international monetary shifts that reduce outside demand for dollars. Together, they can create a difficult environment for savers. And who suffers most during inflation? Usually the middle class and those holding too much cash. Their wages often rise slower than living costs. Their savings lose value quietly. Their future plans become harder to afford. Now compare that to people who own scarce assets. Gold cannot be printed. Silver cannot be created with a keyboard. Land, productive businesses, and useful commodities often adjust over time with inflationary systems. That is why wealth frequently moves toward hard assets during long monetary transitions. This does not mean every year is straight upward. Markets rise and fall. Gold can consolidate. Silver can be volatile. But over long periods of currency debasement, hard assets often preserve purchasing power better than idle cash. Silver deserves special attention here. Many people see silver only as the cheaper version of gold, but that misses the bigger picture. Silver has monetary history plus industrial demand. If inflation rises and manufacturing demand remains strong, silver can gain from both forces at once. Gold often moves first when fear enters markets. Silver sometimes follows later with stronger percentage moves because of its smaller market size. That is why experienced investors keep watching both metals closely. So what should an ordinary person do in a changing world? First, stay informed. Most people react emotionally to headlines. Smart people study trends early. Learn about debt, inflation, currencies, and real assets. Second, diversify. Relying only on one currency, one income source, or one asset class can be risky in uncertain times. Diversification does not remove risk, but it can reduce exposure. Third, think long-term. Reserve currency transitions take years. Gold and silver stories can test patience. Wealth is usually built through discipline, not panic. Fourth, protect purchasing power. The goal is not just to earn money. The goal is to keep what your money can buy over time. And finally, ignore dramatic noise. Some voices will say, total collapse is tomorrow. Others will say nothing is changing at all. Reality is usually in the middle. Slow decline, gradual transition, rising volatility, and growing importance of real assets. The dollar may remain number one for years, but being number one by a shrinking margin still changes everything. That shift alone can reshape inflation, trade, investment flows, and global power. Meanwhile, nations are buying gold. Currency competition is rising. Debt levels remain high. These are not random signals. They are signs of a system evolving. For investors, this may become one of the most important decades to understand money. Those who prepare early may protect themselves. Those who ignore the shift may feel it later through higher costs and weaker purchasing power. The biggest lesson is simple. Do not wait until the crowd notices. By then, prices often move first. If you enjoyed this deep market breakdown, subscribe now to Gold Silver Scope for more powerful insights on gold, silver, inflation, and the future of money. Stay ahead of the trend, stay informed, and stay ready.